Well, greetings and salutations, test takers. This is Dean Tenney coming to my off-grid studio, getting our kicks, coincidentally, not on the Series 66, but Route 66. Jasmine was rude enough to point out to me that there are parts of the explication for the Series 66 that are missing. I've known that it's a hole that I've meant to plug many, many months ago, and it just didn't speak to me for a lot of reasons. One reason is I have plenty of other content that goes over some of these areas. But in the interest of completing the explication, Jasmine has been kind enough to identify for me the missing items. And so maybe we'll call this missing items from the explication. I don't know. We're going to run through the things that we're missing in the first part of the explication. And since we're going to complete it, we'll make it a separate playlist. It's not a separate playlist right now. It's commingled with a bunch of other stuff. So that's the other reason I think this will be helpful. High level. And then I didn't do the laws and registrations part of it because, again, I thought there was a lot of content there. But I told Jasmine I may, be talked into doing that just again to complete the whole explication. I completed the whole explication for the SIE for the Series 7, and I kind of got weak on 65s and 66s and 6s. So, I kind of got sidetracked. All right. So the first thing, Jasmine, you've identified as missing items is A1 and 2 insured deposit money markets. Is that correct? Okay. So demand deposit is just a fancy word for a checking account. And I would know that whether it's a demand deposit, checking account, or CD, that you do have FDIC insurance. So, we don't plan on losing money with a bank deposit. So it'd be an investment for somebody who's very conservative. The other thing I would say is that money market instruments, money market funds and instruments are not insured. We don't think a money market mutual fund is ever going to break a buck, but hey, it's happened. Right now, retail money market funds are more protected. Here, we always, as an investment advisor representative, want to make sure that we have a proper level of cash and cash equivalents. Some people refer to this as an emergency fund. Some people refer to this as our 6 to 12, 3 to 6 months worth of our payments in a money market fund or in a checking account, whatever the case may be. As it relates to CDs, we have what are called negotiable jumbo CDs. And negotiable, let me get out my illustrator. Negotiable means it's a CD that has a secondary market. So if you ask somebody about a negotiable CD, you're saying to Wells Fargo, I want to be able to sell this Wells Fargo CD to somebody else. And traditionally, most people aren't aware of this. Most of them, they say, well, no, this is non-negotiable. You can't sell this. And then jumbo would be $100,000. And so I would know that is considered a negotiable jumbo CD would be considered to fall into the category of a money market instrument because it would be in a money market fund. So you say, Dean, what are money market instruments? I say high quality debt maturing in less than 12 months, like commercial paper. They say, what's commercial paper? I go, large unsecured borrowing by corporations. Issued at a discount with a max maturity 270 days that does not need to be registered with the state. Commercial paper, remember, is an exempt security, so don't have to register it. Primarily because it's not being sold to Joe Sixpack retail investors. It's being sold to, money market fund managers. Treasury bills are the best money market instrument. There's nothing better as a money market instrument than a treasury bill. Right? No credit risk, no interest rate risk. And these two are issued at a discount. There is a couple that I would be aware of that don't show up in this NASA content outline. The other one I would be aware of are bankers' acceptances, which are used to facilitate foreign trade. And these will all be things found on money market. Now, again, when you open an account at the broker-dealer, I say, Jasmine, what would you like to do with your idle funds? We have a traditional bank account for you, but we also have a money market fund available for you. And you say, what's the difference? And then I walk you through it. All right, so that was 1 and 2, liquidation preferences. Very testable. 1.3, where's that at? 1.3. Huh. I just saw it because before we got on the phone, I said, I better check this list to just see. So A, 1 and 2, 1.3. Do we have more than 1.3? There we go, liquidation preferences. Let me clean up my slide. Now, again, like anything, content outlines can be kind of challenging because where they decide to put things in a content outline, and then how test prep vendors decide to cover them, how we decide to learn them. But you definitely are going to get tested on liquidation preferences of common stock, which is the most junior security you can own in liquidation. So common stock, very testable, comes last in liquidation. Now, we have a classical balance sheet equation, very testable. Assets minus liabilities equals net worth or shareholder equity. And the assumption is that we're not going to liquidate the business. But if we do, you have a residual claim. Now, the theoretical liquidation value of that business is known as its book value. That's what should be available to the shareholders if we liquidate. Now, preferred stock test question is senior to the common, right? So that we got to pay off our preferred stockholders before we distribute the residual claim to the common stockholders. Then we have our debentures, our unsecured debt holders. They're senior to the preferred. They're junior to the secured debt holders, secured bonds. I don't know of any draw in which you're not going to be asked to rank liquidation priority from senior to junior, secured debt, unsecured debt, preferred, or common, or from junior to senior, common, preferred, unsecured debt, secured debt. So very, very testable. All right, next on our list is relative comparisons. So as we do our cleanup here, it's tough for me just to go scroll by things that are very testable. And the nag in me feels like saying, oh, you should know that too. Benchmarks are very testable. This is usually done in the format of A, B, C, D. And so there are some benchmarks that we use, particularly as it relates to performance-based compensation. For example, Fidelity does want for performance-based compensation. So Fidelity Management Research is certainly a federally covered investment advisor. They're one of the few investment advisors to mutual funds that have performance-based fees based on if they beat the market. The market on the test question is always the S&P 500. So whenever we're talking about alpha or beta or any of that kind of stuff, VIX, that would be the S&P 500. And that would be the benchmark, very testable for a large cap manager. Benchmark. Again, the idea here is, did I outperform my benchmark or not? I mean, if I don't outperform my benchmark, and sometimes you say, well, Dean, you got no alpha. I said, well, gee, that's pretty rude. You say, well, Dean, if you got no alpha, then why should I pay you? Right? I could just do an index fund and, save some money, right? So very important is S&P 500. We have a benchmark for international investing. That's EFA. That's for Europe, Australasia, and the Far East, and that would be the benchmark for a international investor. I would just point out that when we use the word global, that would include U.S. securities, and when we use the word on the test international, or off, that would not include the U.S. Right? So if I'm looking at a global mutual fund, that means it's allowed to invest in the U.S. If I'm looking at an international fund, it would not be. Small cap would be Russell 2000. We have some other indexes that are testable, but aren't really so much benchmarks as they are indexes that could be in the answer set that you are held accountable for. And the two that I would be aware of here is the Wilshire 5000. If they say what index most closely approximates the total US stock market, that would be the Wilshire 5000. You know, the founder of Wilshire Associates, a guy named Dennis Tito, and Dennis Tito is a serious math guy. He said, I don't know why people talk about the Dow all the time. It's so stupid because, 30 stocks, who cares? He said, I'm going to come up with a much better index. Every time I say Wilshire 5000, I'm supposed to give him a couple bucks. Right? He sold out, went to space with the Russians. I mean, the guy's a rich guy. But he founded the Wilshire 5000 because he didn't like, test question, the Dow Jones Industrial Average. Charles Dow created the Dow Jones Industrial Average, the Dow Jones Utilities, Dow Jones Transportation Index, because he wanted to practice technical analysis. And he was the inventor of technical analysis called Dow theory. And what he created his indexes for was to confirm trends. Charles Dow said, well, if the Dow industrials make a new high, then the transportation company should make a new high because the industrial companies shipped a lot of product, put salespeople on the road, and they just used a lot of power. So utilities should make a new high. And if we had all those making a new high, that would be confirmation of a bullish trend. Technical practitioners are always interested in confirmation or non-confirmation. If the industrials make a new high and transportations don't, non-confirmation. If they all go down, confirmation of a bearish trend. So it's about catching a trend. Now, this is the only index test question that is price weighted. It's not market weighted. And they sometimes ask that on the test as well. Which one of these is, price weighted? And you would say the Dow. It's kind of stupid. They just take the 30 prices, add them up and divide, right? So, I don't want to hurt their feelings, but manager tenure is important in terms of due diligence on mutual funds. American funds, for example, doesn't believe in celebrity fund managers. They have teams that manage the portfolio. Yeah. And, that's part of their, thing. Hey, you don't have to worry about a celebrity manager here and us losing. We had a legendary bond guy named Bill Gross. He founded the PIMCO funds. And when he resigned, they received over $5 billion in redemption requests. I think it was more like, no, 5, but his was 5. I think it was like 38 billion, crazy. So this would be important to say, Jasmine, this is the record of this manager, or this is not the manager of this record. We got a new guy. Now, Fidelity is noted for legendary portfolio managers like Peter Lynch and, Jeffrey Vinnick, and, and that's important because, if, Peter Lynch, now good news, we have succession plans, but, you're entitled to know who is the person managing the money. I like to have some commercials where they said, I had meet your manager, they have a guy on television, saying, hey, if you give me the money, we treat it as a steward, a fiduciary. Oh, great. Now, I brought up a legendary portfolio manager, Fidelity, named Jeffrey Vinnick. And he got a little in trouble managing the Fidelity Magellan Fund as an investment advisor representative. Because Fidelity Management Research said, Jeffrey, that is a stock fund. It's not an asset allocation fund. And Jeffrey said, well, I think stocks are overvalued and bonds are undervalued. And so I've been buying bonds. And they said, well, this isn't a bond fund or an asset allocation fund. Very testable. If we're going to change the investment policy or objective of the fund, that would require shareholder approval. Shares vote, not people. So we're going to change the fund from a stock fund to an asset allocation fund or vice versa. Now, I always think of pooled investments and relative comparisons is kind of like dating and we're looking for a match, right? It won't be a perfect match, but we're trying to match the style of the fund with the customer who's comfortable with that style. They may not be wanting a gunslinger manager. Other people may. We have what's the lady at ARK Investments, Kathy Woods. If you're going to invest with her, you need to be comfortable with her style. Sometimes it's a match, sometimes it's not a match, but are they buy and hold? Are they active? What are they doing? So style is again the comparisons. Now, when it comes to making comparisons, the one thing we're never supposed to do, very Tesla, make unfair comparisons. We're never supposed to stack the deck, right? And so, I got to say, hey, well, yeah, they do a good job. I should make sure we do that. Now, the next one on your list is futures and options that's missing. And again, the reason this one is missing is because 66 is so tough, because I'm never quite sure how much time we want to spend on futures and options for the payoff. And, I have all kinds of videos when I'm messing around with the 66 playlist. I put them in there and I take them out, I put them back in. Okay, first point is hopefully you're taking your 66 not too removed from your Series 7. And that means hopefully you haven't forgotten what a call and a put are. You have a basic understanding. I'll attack the options first. This again is not going to be material to your success on your Series 66. It's there. I would hope we have a margin of safety, could guess B and assign it to the universe and be done with it. However, it's there. So in options, they are fond of giving you hedging questions. Right? I mean, hedging is where we have the stock as an investment advisor representative, a stock position. I'm either going to buy a put to protect that stock position, or I'm going to buy a call to protect that short stock position, or I'm going to do a covered call to generate additional income. Right? So those options definitions, I would know again the difference between European style and American style. I would know that as a writer or short an American style option, I have more risk because it can be exercised against me anytime I can receive an assignment. Whereas European style, I have less risk because I can only be exercised at expiration, right? So basic stuff like that. Futures are actually easier than options, right? Because with options, you have calls and puts, you can buy and sell them. You have 4 basic positions. With futures, you only have 2. You can either go long the futures or short the futures. That's it, right? And so this becomes easier. If you're bullish and you think the price is going up, you would buy the futures. You'd go long the futures. If you're bearish and you think the price is going down, you would short or sell the futures. Right? So all you got to do is figure out what do they think the price is going to do. So, I might say, okay, I'm Hershey. And so if I'm Hershey, what am I afraid of? I'm afraid that cocoa prices could go up. And so if I think cocoa prices are going up, I go long the cocoa futures. Right? And then when I'm hoping, maybe I'm the CFO at Hershey's and the CEO of Hershey says, man, we are getting killed in the spot market. It's like learning a foreign language. That's the cash market. He said, man, our cocoa prices are going up and we're making chocolate and it's huge. I said, well, good news. I have a hedge in place. So while we're getting killed on the spot market, the cash market, I have these cocoa futures that as the price has been rising, so has the value of the futures contracts. And so you just got to figure out up or down, right? If I either speculating or hedging, right? Maybe I want to speculate on cocoa going up, I go long the futures. Short the futures, same thing, right? Do I think the price is going down? If I'm a soybean farmer and I'm afraid soybeans are going to go down in the cash market. So I say, okay, well, if I think soybeans are going down, I short the soybean futures. And I hope to make money from the top price going down on my hedge to offset my loss when I sell my soybeans in the field. I don't want to, I'm trying to avoid like getting into a Series 3 class, but the idea here is I'm always going to do in the futures market today what I'm doing in the cash market later on. So what I mean by that is if I'm Hershey, I'm buying cocoa, so I'm going long the futures. Right? Whatever I'm going to do is the hedge, right? If I'm a soybean guy, I'm selling the soybeans. So I'm going to do in the futures market today, short, sell, what I'm going to do in the cash market later on. One other test question here as it relates to futures. And I call them beauty contest questions, where you have to decide what's more beautiful, a 529 or a cover deal. 529. What's more beautiful, a raw or traditional IRA? A raw. Those kind of questions where they ask you to contrast things Here, as you see, we don't see the word forwards, we see the word futures. And in the beauty contest between futures and forwards, futures are always the winner. And the reason they're always the winner is because forwards, you have counterparty risk. You don't have standardized contracts. So I'll give you my soybean guy in Iowa, right? I could go, Jasmine, to my local grain elevator and say, hey, listen, how about we do a forward? I agree to deliver 25,000 bushels of soybeans to you in June. Now, the problem with that is that negotiated contract, not standardized, not fungible. It's going to be hard to sell that to someone else. You know, the grain elevator has the risk that I either don't deliver soybeans, or if I do, they got mold on them. I don't know if soybeans get mold, but you know, whatever. I got to worry, do they have the cash? So the biggest thing in forwards versus futures that make forwards the winner, or futures the winners, excuse me, is because they don't have counterparty risk. There's somebody in the middle guaranteeing those. All right, our next one on our list is characteristics and risks of alternative investments. Again, very testable. So characteristics, risks, this is J here. Leverage is financial speed. You know, the advantage of going fast is I get to my destination quicker, but I'm taking more risk. Right? The same supercharged speed I'm going to make money with is the same supercharged speed I'm going to lose money with. I always think about leverage as it relates to other things people may be familiar with. I say, how did you capitalize the purchase of your home? Because I'm highly leveraged. It means you put up a little bit of cash and you borrow a lot of money. Now, this is very testable, and they'll give you things like a 2x ETF. And remember, I said 2x would be whatever the benchmark is. On the test, the benchmark is almost always, as I said, the S&P 500. And they're going to ask you about returns. So I'm going to say, it's $100,000. I'll give you a value. I say the S&P went up 10%. What happened to this thing? You would tell me it went up 20%. So if it was 100, it's now 120. It could be 2x, it could be 3x, however they do it. Now, there is a problem with resetting these things because they have costs involved in that. Inverse, very testable. And it could be leverage as well, but inverse goes the other direction, right? So if I say it's an inverse fund to the S&P, and I tell you the S&P goes down 10%, kind of counterintuitive, you go, woohoo! Because if the S&P goes down 10%, then this thing goes up 10%. And that could be leveraged as well, right? So that would be where the inverse comes into this thing. Yeah, boy, you just got to be reading kind of closely. Structured products. What we need to know about structured products. Men and women who are in structured finance, Jasmine, carve up pieces of paper and come up with all kind of exotic kind of investment vehicles. Mr. Buffett, who's resigned here, I guess, the end of the year from his perch there at Berkshire Hathaway, has called structured products weapons of financial destruction. And he says, man, if you can't understand a product, it's probably not a good idea to invest in. But that would be the structured product would be, again, an alternative investment. And here, heightened suitability. I would say to you as a compliance person, or even taking your 66, probably shouldn't be selling these structured products. We may or may not have these structured products available on our approved product list. I know that some firms take heat for not having some of these structured products that people like daily options, for example, or these ETFs that are like based on one stock inverse ETF on Tesla. I mean, crazy stuff. Hey, if you can dream it up and get somebody to buy it, I guess it's okay. ETNs are very testable. What you've got to be able to do on the test is contrast an exchange traded fund with an exchange traded note. They are very, very different. but they sound kind of similar, ETF, ETF. In an ETF, exchange traded fund, there's a custodian that's actually holding the monies and securities. It is an equity investment. There's not a chance that they could default. It's very expensive to do that, to set up an ETF, because you got to, buy the securities to put in it. You got to get a custodian, and the major players in this marketplace are BlackRock and Fidelity and Schwab and Vanguard and State Street, and all those people I have no problems worrying about. But other people want to have something similar, but they don't want to do all the work and spend all the money. And so some sponsors financial institutions will say, Jasmine, you don't need an ETF. Why don't you buy an ETN for me? And I'll just agree to pay you whatever the S&P does. If it's 100,000 exchange rate note, S&P goes up 20%, I owe you 120 grand. Woohoo! And then I don't have to set up, own the securities. I don't have to have a custodial bank to hold the monies and securities. For the sponsor or distributor, it's a wonderful deal. But for the investor, test question, it is a credit or debt instrument and very testable. That means you have the risk of default. I wouldn't have any problem buying an exchange traded note from like JP Morgan or, Wells Fargo or Bank of America as a sponsor or financial institution, because Jasmine, I believe they could and would pay me. But if it's from ETNs or us, I'm like, who are you guys again? So that's the test question there. All right, so we have insurance-based products. Again, not a big deal, but indeed, it could be on there. So did I not cover variable annuities at all in the explication? Well, as I said, the reason I probably didn't is because I have entire videos on variable annuities. You are definitely going to get questions on annuities. So, let's go over this pretty quickly. You're going to get 0 questions on fixed annuities. The only question you could encounter on a fixed annuity is the idea that it's not a securities product. It's on the test, when we say non-securities product, we mean a traditional insurance product. And so that means, you don't need to be, registered to sell securities to get people involved in fixed annuities. When maybe I've been buying fixed annuities for a long time, and I say to my insurance agent, and I say, Jasmine, what is the insurance company going to do with this money? You say, Dean, as an insurance company, we have a general account where we make investments. We buy stocks, we buy bonds, we buy real estate. And we hope to make more than we're promising you. But at the end of the day, test point, you, Dean, are not assuming the investment risk. The insurance company is, and we won't be an insurance company long if, we assume investment risk and we can't do better than we're promising you. And so maybe one day I come in and I say, I figured out what you guys have been doing, man. You've been taking my money and buying stocks and bonds and real estate and making way more than you promised me. Prudential Global Investments, PGIM, investment management, they manage about $600 billion. Crazy. Mainly the general account of Prudential. That's where they're out buying stocks and bonds and real estate and doing all that kind of stuff. And so I say, I figured that out. They said, well, Dean, would you like to assume the investment risk? In a variable annuity, the annuitant is assuming the investment risk. And now what you're going to do is instead of putting it in the general account, you're going to put it in a separate account. And the separate account is just the insurance version of a mutual fund. I saw where this insurance company didn't have much expertise in managing money, and they wanted to set up a variable annuity product. And they thought it would give it juice if they got some really great managers for their separate accounts. And they went and got T. Rowe Price, and they got Fidelity, and they got American Funds. And then they got greedy and decided that they would rather do that in-house and not pay T Rowe and not pay Fidelity and pay these money managers. And, and then they end up having the shareholders say, well, no, wait a minute. You sold this to me as a separate account being managed by, T Rowe or Fidelity or whoever it happens to be. I think of a variable annuity as a mutual fund with an insurance wrapper. And we refer to this sometimes as a non-qualified retirement plan. Non-qualified because it's not coming from your employer. It's not been approved by the Department of Labor or the IRS to be using pre-tax money. And so that's very important because that means the money that you're funding this with is after tax and you have a cost basis. Cost basis is simply when you turn your money into an investment. Right? And at some point, you're going to turn the investment back into money. Now, a very important concept. There's no way in any type of retirement plan you're ever going to qualify for a long-term capital gain. All distributions from a retirement plan, if they're taxed, are going to be taxed at ordinary income tax rates. Right? So you have a cost base, the money's going to grow tax deferred. And then when you're 59 and a half, sounds familiar, you say, Dean, how much is in the separate account? And we're hoping that you had a mutual fund separate account, sub account that did well. I said, Jasmine, as you remember, you gave me $1 million and now there's $10 million in there. I say, what would you like to do? Do you want to let it ride? The neat thing about a variable annuity is you have different choices you can make. You could say, Dean, I'd like to do a random distribution. Send me $1 million. I say, Jasmine, if I send you the $1 million, it's $1 million of the 9 you've never paid taxes on. If we're doing a random distribution from a variable annuity, test question is LIFO. Last money is in, first money is out. So that's how we're going to do a random distribution. So you won't get your own money back until you get down, I send you $1 million, then I send you 2 million, I send you 3 million. You're not going to get your own money back till you get all that, back to that $1 million, right? So that's random distribution. You can do lump sum. Lump sum, you owe not taxes on 10, you owe taxes on 9 ordinary income. The neat thing you could do is you can annuitize. This is a neat thing to be able to do. You can turn this into an income stream that you can't outlive. Wow. Can't do that in a regular mutual fund. A regular mutual fund, when I retire, I say, well, how much do I got in the mutual fund? And let's start withdrawing. That's not magic. At some point, I could exhaust that account. Now, good news, though, I probably qualified for a long-term capital gain. Remember, that's not happening here. I say when you annuitize, we're going to turn your accumulation units. Those are just shares in the separate account. You say I have 10,000 accumulation units in a separate account is no different than saying I have 10,000 shares in a mutual fund intellectually. It's just got this insurance wrapper, which is why it grows tax deferred. If you want to turn it into an annuitize, we're going to turn your accumulation units into annuity units. No problem. I mean, don't get hung up in the language here. It's just an accounting metric. And I say, how would you like to get paid? You say, Dean, I'd like the largest monthly check possible. And I say, okay, well, that would be life only. If we tell the insurance company that you want to be paid for your life and your life only, that will give you the largest monthly payment. So you can annuitize. Now the check, if I send you a check, I say, hey, Jasmine, give me a call when you get that first check. And you go, why? I say, well, I want to talk to you. I said, what's your first check? You say, Dean, I got my first check and it's $10,000. I say, cool. So 9,000, you owe taxes, ordinary income. 1,000 is the exclusion ratio. We were 10%. We had $1 million. Now we got 10. You don't owe taxes on the 1,000. That's coming back to you. I said, when you get your next check, give me another call. And he said, why? I said, because the check is going to go up or down by the assumed interest rate. We have this thing called the heirs. I told you earlier, we won't be an insurance company long if we assume interest rates we can't get. But if we get more than the heir, the check goes up. We get less than the heir, the check goes down. So next month check is either going to be the same or more than or less than. We're not going to take you from like 10 to 20 to 2. No, we're just going to bump you. So the law of large numbers, the law of averages, it'll all work out. It'll all work out. Now, we also have, I'm sure at some point I'm going to get an insurance person who's going to get upset with me. There are some traditional insurance men and women who are terrified to take securities exams. And they want to have some kind of a product that has a market-based return. And if they don't take a 6 or they don't take a 7, they can't sell variable annuities, where you would be exposed to market risk and returns. And so we came up with for them what's called an equity indexed annuity, very testable. The first test question is that equity indexed annuity is a traditional insurance product. It's a non-securities product. And the reason it's a non-securities product is because your capital, your principal, is not at risk. Securities products, your principal is at risk. Now, the way we say that is there is no negative reset. So, if you buy an equity indexed annuity, I say, Jasmine, we're going to give you 80%, that's your participation of whatever the referenced index does, usually the S&P 500. So if you have an equity indexed annuity of 100,000, and I told you the market return was 20, you say, okay, well, 80% participation would mean 16,000. So I say, Jasmine, we owe you 116,000 now is the value of your annuity. You go, woohoo. Market goes down 20%, you're never going below 116, regardless of what the market does. And that's a test question, this idea that you can't lose your principal. Security products are principal at risk, right? I had a client once, I said, how are you going to feel if you lose this money? And he said, I'd kill myself. And I said, well, then you don't belong in securities markets. You need to be talking to an insurance agent about an insurance product or, a banker about a banking product, because securities products have risk. Life insurance. So life insurance is a key component of an estate plan. I always talk about my friend Jim. I said, Jim, to say I'm the guy talking about life insurance is really, means you need life insurance. But I'm not a life insurance guy. And he said, well, I don't want to make a bet with an insurance company that I got to die to collect. I said, well, Jim, that's the wrong attitude. It's not about you. It's about your wife, Michelle, and your daughters and what happens to them if you're no longer around. The proceeds from life insurance test question is tax-free. So, this would be helpful to have this money available to, finish things. Now, one thing that we get asked about on the test is that what we should do with Jim, if I'm going to sell him insurance, is a capital needs analysis. Just kind of see, what's going to mean, how much are we going to need? Does Michelle want to go back to work, or does the daughters need to go to college? Maybe we need to pay off the house, whatever that is. Now, the trick on the test is we can't use a capital needs analysis to sell more insurance. So they'll say you would use a capital needs analysis for all the following, and they would say, one of your choices is to sell somebody some more insurance. No, right? We want to meet their needs. It's not an excuse to try and get some more commissions. All right, so traditional life insurance whole, the premium schedule is fixed. You have a guaranteed death benefit. You have guaranteed cash value, and all the money is going into a general account. Term, you just want to get paid if something happens to you, want a lump sum. And, a lot of people say buy term and invest the difference, whatever the case may be. There's not going to be any kind of cash value buildup in that product. Universal has a flexible premium. You can skip it, right? So I say, hey, my business is slow. It's seasonal. Sometimes I'm making lots of money. Other times I'm making no money. My insurance guy says, Dean, well, good news, you have universal life. So you can skip the payment. There's no guaranteed death benefit. There's no guaranteed cash value. All the money is going into the separate sub account. Now, that's the other point. This separate account, if it all works out, is going to pay for the cost of insurance. We're never supposed to sell life insurance as an investment, right? As an investment. Variable life, we have a minimum death benefit guaranteed, right? And we have no guarantee on the cash value, and the money is some of it's going to the general account, some of it's going to the separate account. If you tell me you missed your mark on 66 because of life insurance, I'm gonna say, yeah, I don't believe it. Maybe one or two questions. It's not high risk, high reward. Other assets, commodities. Okay, the test question here is, why would we put commodities into a client's portfolio? It's a good inflation hedge, right? So whether it's, soybeans or whatever it happens to be. Stupid but testable, precious metals are not, copper is not a precious metal. So, stupid but testable. But we use precious metals for the same thing as an inflation hedge. In and of itself, commodities and precious metals may not seem like it would be an appropriate investment, but in the context of an entire portfolio, it might fit in there somewhere, right? Digital assets. NASA is very concerned with digital assets being sold as securities rather than currency. Cryptocurrency, a currency is a medium of exchange. Think Bitcoin, Ethereum. Those are cryptocurrencies. They're not securities. NASA has agreed they're not securities. They're not being sold as investment opportunities with third-party management. What the NASA is concerned with, and your 66 is concerned with, is digital assets that are being sold as securities, as investments. Because if that's how they're being sold, then that means those digital assets, if they are securities being sold like securities, need to be registered. And we certainly can't use coordination. So we'd have to qualify. We'd have to say, what do we need to do to sell this digital asset as a security? And again, there's all kinds of lawsuits about is it or is it not a security. For a while, the state administrators and the SEC had the upper hand. Then we had a regime change. I'm joking, but we're now crypto guys are getting the best of it, and the SEC saying, okay, well, like Coinbase is saying, well, we want to comply. Just tell us what we need to do to comply, right? So distinction characteristics, risk. We said it's going to be up to the state administrator about whether you're selling a security or not. All right, so that is coming in about an hour. I know we still have on our list a lot of stuff here. So I'm going to call it on this one. Let me stop here, Jasmine. Hold on just a sec.